If you looked at markets recently, you'd sort of conclude they only go one direction.
Yeah,
there has to be a stop to this. How do you interpret what we're seeing?
Well, look, there's the macro, there's the micro, then there's the risks that are out there. And so from a macro standpoint, what is clear is that the broader economy and corporates have been able to weather this meaningful increase in rates. And as I said earlier, the Fed decided not to cut rates thus far this year because inflation is real, and you've heard Kashkari this week and others say we've got to see more data. But I think that speaks to the resilience of the economy today. Now, my own personal view is that what we're benefiting from still today is the stimulus of a couple of years ago. And that stimulus is working its way through the system. And we're also still working through post-COVID. I mean, again, it is certainly at this point years ago, 4 years ago this spring, but behaviors have changed, consumption has changed. And so the real question is when do the effects of stimulus and changes to consumption change? My sense is there is a reasonable chance we start to see some modest slowdown in 2025. Obviously, it's a big political year, so we'll see what happens with fiscal policy. But I think for the near term, we see a reasonably solid economy. Where we see weakness is on the very low end of the consumer side. But that's it. You see a little bit of delinquencies picking up. And so when we look at our portfolio, again, we're credit investors, not equity investors, although our philosophy is to buy the company, as our mentality is this is all about owning companies. But with the amount of cushion we have, again, I think we can weather some softening. And again, I think we were in, if you go back to the 2008 to 2009 to 2019 period, we were able to grow at low growth and low inflation for a long time. The question is, will some of this wage inflation start to temper? Where will our immigration policy be? Where will the post-COVID mentality on work, will it revert back or will it stay the same? And so it's a delicate balancing act, but I think from a macro standpoint, we're okay.
Part of it is the stimulus that was injected during the great financial crisis to get us out of that, and then with the pandemic, as you say, we've had a series of crises. But how much of it also is psychological? At this point, the markets and people in the markets basically assume daddy's going to bail us out no matter what happens.
Well, I don't know if it's daddy's bailing us out, because if you look at it, the COVID distress cycle was about 2 weeks. So it wasn't even, oh wait, it took 6 months. I think there is, if you look at the breadth of the market, clearly NASDAQ, anything that has AI has exploded. And one of my partners at our recent annual meeting said, if credit people are talking about AI, it's real. But there is definitely a sense that we're in the earlier stages of an extraordinary growth wave with AI and what that does. Now, again, there could be ripples to that could hurt employment. Certainly, there's lots of commentary on what it could do longer term to unemployment, and maybe there'll be some interesting impacts to slowing down inflation at that point in time. So I look at equities, and their trajectory has surprised me, especially given where rates are. But this growth trajectory and people's fear of missing out, the FOMO that's in the equity markets. In credit, again, I think spreads have come in some, but as I commented earlier, when you adjust for the quality change, it's actually reasonable. And certainly in private credit, when I look at the opportunity to make 10+% unleveraged in multi-billion-dollar companies at a 40 to 50% loan to value, that feels really good to me still, even though spreads have come in 100 basis points.
We rely on prices to actually indicate where we should be investing our capital. As individuals, as a society, where's the most efficient place to put your capital? By the way, CEOs use it for that purpose as well. Sure. Is there a danger of undermining the reliability of prices as a way of allocating capital when the government's playing in the game the extent to which it's been?
The government has always played in the game. Again, I do think that part of the reason why M&A deal activity, buyout activity is down 40+% from a couple of years ago is because rates are higher. I mean, the price of money and how one thinks about discounting future cash flows is fundamental. And yes, the government plays a role in setting the short-term rate. The markets play the role in setting the medium and longer-term rates. And so I'm a big believer in the markets, and yet there are obviously incredible inefficiencies, and there are obviously moments when the markets get it all wrong. Again, 6 months ago when I sat here, the forecast was for 6 25 basis point cuts, 150 basis points. And instead, the 10-year's up 75 basis points. Instead, those cuts have now gone to maybe 1 or 2. So that's where there's opportunity. And like there's opportunity in rates markets for people who want to make those calls. There's opportunity in picking individual credit. And that's what we do. We have a portfolio of 750 companies today across our 64 billion of capital. And we're looking at thousands more. And so you have the opportunity to pick, you have the chance to take a stand on what you believe in: good businesses, good management teams, good industries, good sponsorship, good capital structures, right documentation, right pricing, fair pricing. You'd rather sacrifice a little on pricing than on quality or documentation. So I think there's an enormous opportunity to be made in what we do, and whether equities go up 10, 15% forever, if you can make 10% high singles, low double-digit returns in credit, that feels awfully compelling to me.